one of Nvidia's memory suppliers, just posted a 346% jump in revenue. You'd expect the stock to be expensive, but it trades at 6.5 times next year's earnings. That's not a discount, it's a symptom. And the price I'd pay for the stock is a long way below where it trades today. The stock is Micron, and the first symptom showed up in August when DDR5 memory was selling for close to 5 times what it costs a year earlier. That's not HBM, not the stacked high-end memory that sits next to an Nvidia GPU in a server rack. That's the ordinary stuff. The memory that goes into a laptop, a PC or a phone. When we go back 2 quarters, conventional DRAM contract prices rose 93 to 98% in Q1 of 2026. Then another 58 to 63% in Q2. They didn't just drift upward. They first doubled and then rose by more than 50% again in the next quarter. At first, this sounds positive for Micron. But it creates a problem in the story everyone's telling about them. The demand people point to is AI. Hyperscalers and data centers with memory stacked next to the GPUs. But the buyer who actually absorbed the price increase was someone replacing a 5-year-old laptop. They never bought an AI chip, but they paid for one anyway. So how does the buying spree in one product double the price in a different one? They are not even the same product. But they come from the same wafers in the same fabs. And once you understand what Micron gives up to build one, the year stops looking like a demand story. 3 to 1. That's the trade ratio between HBM and DDR5, and it comes from Micron's own CEO. On the December earnings call, Sanjay Mehrotra said HBM demand was challenging the supply environment because of, his words, the 3 to 1 trade ratio with DDR5. That means that 1 bit of high bandwidth memory eats about 3 times the wafer area of one ordinary DDR5 bit. The reason is physical. HBM isn't just a faster chip, it's a stack. 12 to 16 layers of DRAM bonded on top of each other. And of course, that needs more silicon and it's more difficult to manufacture. Applied Material counts 19 extra process steps compared to conventional DRAM. And it's only getting worse. Micron told in a conference this year that by HBM4, the ratio moves closer to 4 to 1. But a fab has a fixed number of wafers they can handle. Moving one wafer to HBM doesn't just add HBM. It takes 3 wafers worth of ordinary memory out of the market Micron also sells into. When you do that across all 3 suppliers at once, the industry can spend record Capex while the volume that is actually reaching the market is barely growing. So that's the mechanism behind the business. And if it's real, Micron's record year shows up in price, but not in volume. And that's testable because the company reports both. Micron's revenue last quarter was $41.46 billion, up 346% from the same quarter last year. Now hold that against what management said about volume. On the same December call, Mehrotra told analysts he expects industry bit shipments to grow around 20% from 2025 levels. And Micron's own shipments about the same. His CFO called those gains supply constraint. Revenue up 346%. Volume about 20. Everything in between these numbers is just price. Now look at what that does to the income statement. Over the last 12 months, Micron turned $90.3 billion of revenue into $95.3 billion of operating profit. A 65.7% operating margin. At the top of the last cycle in 2022, the same company managed 32, and in fiscal year 2023, it was negative. But no hardware manufacturer earns 65 cents of profits on the dollar of revenue because it got better at manufacturing. It earns that because the market it sells into ran out of products. And that's exactly the distinction that decides how you value this company. Because franchise earnings come from what a business controls. Volume it wins, market share it takes, products it can price because nobody else builds them. But cycle earnings come from scarcity. Micron didn't take market share this year. In the last quarter of 2025, its DRAM share fell 4% from 26% to 22%. Third place behind Samsung and SK Hynix. So the earnings are real, but they were triggered by a shortage, which should make the stock look expensive on any normal measure. But it actually doesn't. Micron trades at just 6.5 times next year's earnings. And that number is the entire reason people think it's cheap. Now, if that distinction, cycle earnings versus franchise earnings, is the thing you want to have more of, hit subscribe. I post up to 2 of these videos every week, and I will honestly tell you if I think something is overpriced even when everybody else is buying it. But back to the multiples. 6.5 times forward earnings. The question nobody asks is, 6.5 times which earnings? Micron's fiscal year ends in late August. So there are 2 consensus numbers and they are not close. For fiscal year 2026, the year that's about to close, consensus is $73.21 a share. At today's price of $940, that's 13.8 times earnings. The consensus for next fiscal year is $145.52, just 6 times next year's earnings. The number everyone quotes is the second one. So the cheapness people point at isn't a fact about what Micron earns. It's a forecast of what it might earn. In a business where earnings per share went from minus 5.3 in 2023 to 7.6 in 2025 to a projected of 154.9 in 2027. On a trailing earnings, the stock trades at 22.9 times. On book value, the least forecastable number on this page, it's 10.8 times, against 1 or 2 at the bottom of past cycles. My own quant scoring system lands in the same place. Micron scores 7.1 out of 10 overall. Growth, 9.9. Financial health, 9.2. The value and momentum for the next 5 years is 6.3, and inside that, the momentum scores are perfect 10s, while the price to free cash flow and EV to EBITDA only score 2 out of 10. But the quality score is only 4.3, with a low mode rating and a large customer concentration. So every backward-looking number is a 10, but everything about the business durability is a 1 or a 3, which makes the low multiple the entire bull case. And a single-digit multiple on this stock has shown up before. 3 times actually. In the summer of 2014, Micron was at $37, trading at low single-digit forward earnings. 12 months later, the stock was down about 70%, and by early 2016, it was even under $10. Or in May 2018, $64, 4.5 times forward earnings. Down 57% to around $28 by the end of that year. And early 2022, $98, forward PE at about 11 times. Down roughly 50%, and the following fiscal year, Micron's earnings got even negative. So we have 3 peaks, 3 cheap multiples, and 3 drawdowns of 50% or more. That almost looks like a rule if there weren't August 2017. Back then, Micron stock traded at around $32, with a trailing PE of 8.7 and a forward PE of around 4.3. By every version of the signal I just showed you, that was a sell. But over the next 12 months, the stock went up more than 60%. It topped out in May 2018, the second peak on our list before it crashed. So the signal wasn't wrong, but it was early by almost 12 months, which for anyone who acted on it is the same as being wrong. And that's exactly why I won't put a date on the stock. The supply I can date. New fabs are already announced, the timelines are public, and most of the new capacity lands from the back half of 2027. What 2017 proved is that the supply schedule isn't the price schedule. Capacity was coming then too, but the demand outran it anyway, and the stock ran 60% higher before it broke. But there is an argument that says that none of that history applies anymore, and it has $100 billion attached to it. $18 billion in cash. not revenue, cash, will be wired to Micron by customers who haven't taken any deliveries yet. That's not nothing. Especially since memory used to be sold on spot prices or renegotiated every quarter, which is why the crashes were so violent. When demand vanishes, the revenue vanishes with it. Take-or-pay contracts with cash already wired are a different arrangement, and the bull case says that they have broken the cycle. Here is what the filings actually say though. The arrangements have a ceiling price, roughly the market price in the second quarter of this year, and they have a floor. Micron discloses the ceiling. It doesn't disclose the floor. So the upside is capped at roughly today's price, and the downside protection is a number nobody outside the company has seen yet. If that floor sits near 2023 levels, it doesn't protect this year's earnings. It protects Micron from losing money. TrendForce puts it even more bluntly. Their read is that the long-term agreements restrict suppliers from raising prices for those customers. So the increases land on everyone without a contract. The agreements aren't Micron's shield. They are the hyperscalers. And the size doesn't work either. 100 billion is the whole order book through 2030. 4 years. Micron's data center business on its own is running at over 100 billion a year. So the entire contracted revenue is worth about 1 year of just the data center business alone. Everything else, phones, PCs, enterprise drivers, is still priced quarterly. There is a second version of the bull case though, and it's the one I can't take apart. Because it doesn't rely on contracts at all. Data center is now 60% of what Micron sells. $25 billion out of 41 last quarter. This isn't a phone memory company with a data center side business anymore. It's the reverse. Management's own view is that this doesn't unwind soon, on the contrary. They expect tight supply and high demand to persist beyond 2027, with AI demand running against structural supply constraints. If that is correct, the cycle won't arrive in time and my numbers are wrong. I can't refute that. Nobody can. Yet. What I can do though is look at what's being built to meet that demand. Micron's own Capex is going from about $28 billion this fiscal year to the mid-40s next. Their next generation DRAM and NAND nodes begin volume production in the second half of 2027, according to Micron's management. And they are telling investors to expect the ramp of significant greenfield capacity in the years ahead. That's the supply side. Now, watch what's already happening to the price. Conventional DRAM contract prices rose 93 to 98% in the first quarter of this year, then 58 to 63. But TrendForce's forecast for the third quarter is only 13 to 18%. Still rising, but rising a lot slower. And that's before a single new fab has come online or shipped anything. And Micron isn't even arguing with this. They are guiding to a record 86% gross margin for Q4, and the reason the CFO gave for that number was, his words, a meaningful moderation in the rate of price increases. Now, none of this tells you the price of the stock. It tells you what has to be true for today's price to make sense. So let's put a number on it. For my discounted cash flow analysis, I used the $15.6 billion of unlevered free cash flow from the last 12 months. 2 of those quarters are from before memory cycles went vertical, 2 are from after. And I did this on purpose. Because if we just extrapolate the most recent quarter instead, we get a number several times larger and a fair value to match. But extrapolating a peak quarter is dangerous in this industry. So the model gets the average of the volume ramp, not the top of it. I also used 8% growth a year for the next 5 years, then 2% forever. All this with a discount rate of 10.4% calculated with these inputs. That gives a fair value of $237 a share. The stock is $940. Now, before you throw that out, the terminal value in that model implies Micron exits at 12.2 times free cash flow. That's an ordinary multiple and around the average value the company had over the last years. I haven't assumed a collapse, I've just assumed it's normal. So when we use this and run the discounted cash flow backward to find out what short-term growth rate would be necessary to come to today's price, it's 48.3%. Free cash flow compounding at almost 50% a year, every year for the next 5 years, and then a normal business after that. And it isn't even close. The top left corner in my sensitivity matrix, with a 6.4% discount rate and 16% growth for the next 5 years, gets you $609. That's the single most generous sell on the page, and it's still 35% below where the stock trades today. Now, to be honest, every number I just showed you rests on one assumption: that memory prices stagnate and eventually come back down. If AI demand keeps outrunning the supply beyond 2028, my model is wrong and the fair value is wrong. But when I give the supercycle its own case with 15% free cash flow growth for 5 years, a lower discount rate and a higher terminal growth rate, I still get a fair value of $342. So the cycle case, which is my base case, is 237, the bull case is 342. But the stock is still 940. So both scenarios lose. Which is a strange thing to say about a stock with a $1,500 analyst target on it. And this isn't a mistake, but this is a view about what happens in the next 4 quarters, and it contains no opinion at all about what happens after, which is exactly why both things can be true at the same time. Micron can be worth $237 on a full cycle basis and still trade at $1,500 next spring. And in 2017, that's exactly what happened. The value case was right, but the momentum case paid better for almost 12 months. But timing a memory cycle top isn't a skill anyone has, and I'm not gonna pretend that I have it. Just look at the earnings line one more time. Minus $5.30 in 2023, $7.60 in 2025, 154.9 projected for next year. A price to earning ratio doesn't mean anything when earnings move like that, which is why I like to use the cash flow instead. So while there still might be some short-term upside, this is not a sleep well at night stock. It never has been, and I would watch my investments here carefully. So here is my buy price. The last 3 peaks fell 50%, 57% and 70%. From $940, that's $470, $404 and $282. My discounted cash flow model says 237. Where those two ways of looking at it overlap is roughly in the $240 to $280 range, and that's where I'd start buying. And the 3 things I'm watching are: first, the price trajectory. Right now, RAM prices are still rising. TrendForce has conventional DRAM prices up another 13 to 18% this quarter. That's not a top, but it's the growth rate that matters. That growth series I showed you, 98, 60, 18, it just has to reach 0. Then, second, Micron's own gross margin guide and the sentence they attach to it. For next quarter, this is 86%, but the moment they guide that number flat is the quarter the stock reprices. And third, the supply itself. The first output of the Idaho fab is mid-2027. The whole industry adds 20 to 30% of the total global capacity by 2028. That's when the current constraint on supply could turn. What would flip me bullish, on the other hand, is if Micron would disclose those contract floor prices and they are anywhere near today's levels. Or if the demand is still running ahead of supply when that 2028 capacity actually lands. Because that's the one thing nobody can model. What would make the situation even worse than my assumptions is when contract prices would go flat, while Capex is still above $40 billion a year. That's exactly what happened in 2018. The Capex commitments outlived the price and the demand that justified it in the first place. Now, if you've made it so far and think that my analysis earned it, it would mean the world to me if you like the video and subscribe for the next one. Then please tell me if you think I've got something wrong and not that Micron is a buy. What number would you put on mid-cycle earnings? Let me know your thesis in the comments. And if you would like to know why the industrial compounder Eaton gets all the backlog while Nvidia gets the headline, watch this video next. And of course, this is no financial advice, so please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching, guys, and see you in the next video.